All right, welcome back to Income Trading 101. I wanted to take a look at some of the banks. Obviously, tomorrow we've got a Fed funds rate announcement. I think there's a mix of expectation. I think prior to this past weekend with Credit Suisse falling, the expectation is 25 basis point increase. Before that, before the Silicon Valley Bank and Signature banks, you would have expected possibly a 50 basis point. The good thing is that the CPI numbers didn't look too horrible, and the question is really going to be, will the Fed move forward with the 25 basis point increase in the Fed funds rate, or are they going to back off for fear of damaging the banking sector? And for those of you who don't understand why the banking sector is so important, it largely defines how the overall U.S. market is doing in general. So let's go ahead and just make sure that I'll make sure I get the right display there. I'm gonna go boom like that. And let's open up the chart so we can start looking. All right, so this is Bank of America. You can see what the banks have really been doing since mid-February or early February, and just the accelerated fall. Given the failure of other banks is never supportive of the system. So let's just look at some technical analysis. Even though we know that tomorrow there will be some big news about banks, whether it's nothing or a lot. So as usual, I start off with a wider look at what I'm looking at. This is my attempt to, look at the forest and not miss the forest for the trees. I'm going to go ahead and tighten it up. We will actually do a little Fibonacci retracement there too, but let's go ahead and go back to sort of a shorter term focus. Like to do 12 months roughly, be right around there. It's a little more than 12 months. We're going to go ahead and add our indicators, pull a couple of moving averages. We're going to look, of course, at the 10-day, the 20, and the 60. So this one, since I did the red, is going to be 20. Next up, we're going to look at the 10. Turn that green. I like the shorter term being my indicator of movement up, and the longer term being my indicator of either stability in the case of the 60-day or the sell signal in the case of the 20-day. So let's go ahead and do that. So there we have it. Right now, no surprises there. When we're looking at the daily chart, they're all in line. The 60 is above the 20, which is above the 10, which means that this is a classic bearish signal. We'll see whether it's going to be bearish at every level. So let's swing out to the 1 month. 1 month is actually converging. You've got the 20 period above the 10, and the 60 period is next. So you've got the 10 in between the 20 and the 60, which means that they are converging, and it's not clear at the monthly level whether this is going lower. In fact, if you look at the monthly, you had a nice upward move, upward channel. I could easily draw there and extend that down, but you've had a break of it. Let's just look at that just to make it clear, and I won't keep it on. I don't want to deviate too much from our normal here, but I just want to see how much of a break we're looking at right now, right? And you saw this drop below. You could have said extend the channel to include that period, but I don't want to overfit my charts. And we have a similar scenario right now where we could very easily end up having some time period below this channel before it pushes back higher. So I'm not a full-on believer just yet. So let's go ahead and go to the weekly. At the weekly standpoint, Looks like we are bearish with the 60 above the 20 above the 10. I don't know if you can see that in there, but these three moving averages are in line at the weekly. And then let's just take it lower to like a 4-hour, and the 4-hour is confirming the daily as well and the weekly, which is still bearish. So we're seeing bearishness in all three time frames. We looked at the 4-hour, the 1 day, the 1 week. I'm sorry, the weekly, and then the monthly. So all of those are bearish, and that's what you would expect. I mean, B of A fell from, you've got basically $37 all the way to almost $28. So that's almost, I mean, that's just shy of a 30% move. It's pretty significant. So over the last, what would that be? 6 weeks? Yeah, 6 weeks. So huge drop. Let's go ahead and take a look at the MACD just to get a sense of how momentum is playing out right now. And of course, if you have any questions about how I use the analysis, the indicators I'm using, go over to incometrading101.com. The link is going to also be in the video. You can ask for, I have a free ebook. You just enter your email address. I'll email it directly to you. And don't worry, I won't bombard you with a bunch of emails. I just let you know if I have an upcoming webinar or something like that. So when I look at the MACD, I want to get a sense of how it's responded to price before. So you can see this big green is what triggered this cross in the MACD back then, and crossed the zero line fairly quickly and still had some extra space. I oftentimes want to see, like, okay, when both lines have crossed the signal line, if I had bought there, would I have made some money? I would have. I'd have made, roughly 10%. And then you had a cross lower here, and I like that cross lower because it actually crossed lower, and unfortunately, if you waited for it to cross the zero line here, you would have missed most of the move. Crossed back below in the overbought zone or oversold zone, crossed the zero line here. You actually would have caught this nice little move higher, and then it crossed over. So here we are in the oversold zone again, not really moving towards a cross just yet. Normally I would check all of the different time frames for the MACD, but we're going to look at more than one chart today, so I want to make sure I save some time. But definitely wanted to start off with Bank of America. Now let's do some little Fibonacci retracement. So gonna do it from this peak back here. So we'll take this peak and take it all the way down to this current low, just to see if we were to get a retracement. You might expect to see us at least go back to maybe a 50%, which would be this 38.8. But we still are in many ways, in many senses, still might be making new lows, making some new lows because of the Fed announcement. So much is riding on the Fed announcement tomorrow. And I do like an idea. I like when it's, buy the rumor, sell the fact. But so far, the facts around here recently have just been banks going under. And the question is, what is the Fed going to do? And how might that affect these other banks? So last thing I want to look at, of course, is the volume. I like taking a look at the volume profile. And one of the things I like about TradingView is that it comes with this built in, so we can really take a look at it. So this red bar sort of shows you the high area for the volume. And I like to see, and you can see this area provided a little bit of support here, a little bit of support here, a little bit of resistance back here in July and August. So, and we are nowhere near having that volume sort of magnet, if you will. So the magnet, if you look at this from a magnet standpoint, then that says that we'll probably be pulled, price will likely be pulled back to this region. But of course, that could change. But if it were pulled back to that region, We're talking about a 33. We're talking about a $5 move from here, $5.50 even. So, or 5.30, So very nice. Certainly worth considering. If I were going to make a trade here, it might be something along the lines of selling. I'm not prone to sell call spreads down here. In fact, if anything, with stock being so low, I would be more prone to sell put spreads, figuring that I have a relatively capped downside and I'd want to own the upside. The one caveat, of course, is that there's a Fed announcement tomorrow. So you don't have to rush into a trade. I personally am taking it pretty light right now and waiting to see what the Fed is going to hand me tomorrow. And then I'll trade. Like, I don't mind missing a little bit of a trade. There are trade opportunities so many times during the year. You don't have to rush for every one. Sometimes it's better to just wait for whatever is going to happen to happen. All right, let's take a look at JP Morgan. You can see it did pull back higher, but it has not fallen nearly as much as Bank of America has on a percentage basis recently. Let's go ahead and take a look at some moving averages. And I'm going to go ahead and change them just like I always do. So we're going to go green for 10, red for 20, and we're going to go yellow for 60. Let's get a sense of where we are. All right. So for JP Morgan, this is barely. All three are in line. The 60 above the 20 above the 10, which is bearish. I'm willing to bet, though, as I go back in time, it's not going to be nearly so much. So at the weekly standpoint, we're still bullish. Look at that. The 10 is higher than the 20, is higher than the 60. If I go back to the monthly, I would imagine that is also converged because the 10 and the 20 are nearby. I'm sorry, the 10 and the 60 are nearby, and the 10 and the 20 is on top. But most importantly, I don't know if you can see it there, you've got a scenario where the 10 period is above the 20, but below it's above the 60, but below the 20, which I look at as convergence or kind of a lack of a strong signal to specify. So let's drop all the way down to the 4-hour just for consistency's sake. The 4-hour is definitely bearish. You've got all three indicators in line. So lots there. Definitely expecting bearish if there is unusual Fed activity tomorrow. I'm going to go ahead and get rid of these. We're going to add in that MACD. See how the MACD is looking right now. And right now, the daily, the MACD, this sideways movement it makes the MACD far less valuable. Even if we get a crossover here soon, it's not going to be one that I trust like I would have trusted this one back here with an immediate cross above the zero line and this nice little run. But this is a classic example of why I like to wait for these patterns to go underneath the zero line. It's because they can pull back higher with a little momentum and leave you in a situation where you didn't make any money on your trade, and that's no fun. So I'd be waiting for. We're in oversold once again for JP Morgan as well. So we'll see if we get a cross here and a push higher. And I imagine that's only going to happen if the Fed decides not to raise rates, or the economy somehow everyone decides that, hey, it's okay. Let's just have fun. So let's look at this retracement. This is a full retracement here. So we're going to go top to bottom there, and looks like this retracement topped off just shy of the 61.8. That to me is a full fib retracement. So it's sort of all bets are off for this next move. We could go lower, we could go higher. Who knows? That the analysis isn't really giving us as much of an indicator. And then let's take a look at the volume, see if there's anything to notice here. So, wow, that's so interesting. So our highest volume, or our average volume, really is down here in the 115 area. And you can see how that sort of played as both support and resistance down here for that region. But we are, wow, when I shrink it out to that time frame, it changes as well. So this volume indicator is clearly tied to time, how much time you're looking at. So let's just swing it on out. Look at that. If I stretch it, if I shorten the time frame to 1 year, it means that our high volume, it didn't fully leave down there, but it definitely stayed up. It changed it to up here, and we see that actually played resistance, support, for that time frame. So anyway, we'll just keep pulling that on out, see if that changes anymore. Let's go ahead. And sorry, I would normally say, bullish, bearish, or whatever. I mean, if I were going to get bullish, I actually liked how low that Bank of America chart is relative to relative to the JP Morgan. Let's take a look at Citibank. That's another one of the large, Citigroup rather, large banks here in the U.S. And this chart actually looks very similar to the Bank of America chart. Very, very, very similar. So we can look at moving averages, but we won't have to do a whole lot. In fact, let's just go ahead and lace those, not lace them, put these right on top of one another. And check it out. So you have a lot of similarities there. Look at this. Almost same movement. B of A kind of moved up a bit, but then they're moving in sync, heading lower. Yeah, this is almost the same chart. Some differences, obviously, but look at that. I mean, I don't want to overfit. Like I said, you never want to overfit, but that's pretty tight. So one thing, and I'm not going to do a full analysis here, so it's going to be very similar to Bank of America, but from a trading standpoint, it does give you an ability to make some fun trades. So for those of you that trade stock, you can always be long run one of them, sell the other, and look to trade the spread. Or if you end up in a scenario where you can't get out or get into one of them, you can use the other one for liquidity. From an options standpoint, you also can have some nice long and short, buying call spread or buying calls for out of the money calls on one side, maybe buying some puts on the other, or selling some calls just to offset things. So definitely worth taking a look at. I really expected JP Morgan to be more in line with these two, and it clearly was not. But we'll just see what happens tomorrow when the Fed fund analysis. So the Fed announces the Fed fund rate. So that's it for today's show. Again, if you have any questions, feel free to, number one, you can reach out. If you go to the website, you can also go ahead and request the free ebook that I have, or you can also watch a video that I created. It should be in the links here in the description, that gives a basic tutorial on technical analysis that I end up using here. So that's it. Hope you guys are having a great day. Take care. We'll talk soon. Bye-bye.